Hello everyone, this is Dr.R.Thulasiram, Associate Professor, Department of Social Sciences, Faculty of Agricultural Sciences, Bharat Institute of Higher Education and Research, Chennai. Today the topic for discussion is farm inventory and balance sheet. So it is one of the important topics that is being covered under the course Farm Management, Production and Resource Economics. So this particular course will be handled for the second year BSc Honors Agriculture students, and that will be handled in every third semester of the course. And this course consists of three segments. The first one is farm management, the second one is production economics, and third one is resource economics. And this particular title, farm inventory and balance sheet, that will be covered under farm management segment, that is management of farm. So what is management? It is the art of doing works by others, getting done by others. We may have a work, okay, we may be a manager, we may be a farmer, or we may be considered as the owner of the farm business. How we makes these jobs done in our farm by using others, that is called as management. And if these management practices will be, if it is happened inside a farm business, then it is called as farm management. So inside a farm, there is a concept called farm inventory. And we also, the farmers has to prepare a sheet called balance sheet. So about these two topics will be very briefly dealing in this particular class. Let us move on to the topic. First of all, we should understand what is farm inventory, right? Inventory is nothing but it is a place where we will have stock of goods. Okay, stock of goods in the sense we will be keeping lots of assets inside the area. Okay, so that place is called inventory. That is called as inventory. But what kind of assets that we have inside there means in our business, what are all the different assets that we use to run our business, that will be kept inside an area or inside a building or office or store. So that is inventory. So all these assets will be having a value. All these assets possess a value. So when you list all of these physical properties of a business along with their value at a specific date, okay, that is called as inventory. So it is a complete list of farmers' assets with their valuation at a particular point of time. We are not only going to list out the assets that we have inside our farm, but also we need to give value for those assets before you list out those properties. Okay, so all these things are physical properties, right? So along with that, when you make a list of items that is being included in our inventory in a notebook or record or something, along with the name of the item, that is, say for example, rotavator, harvester, tractor 2 in numbers, sickle 15 numbers, right? So pesticide bag, right, chemical bottles, etc. So when you list out all these physical numbers, along with that, we need to make a mention about the price of those items and how much value that you have in the form of stock, how much is being utilized for the farm business and how much is being remaining that is being kept inside the inventory, and the particular year when it was purchased by the farmer, right? That has to be mentioned, and the expected lifetime also that has to be mentioned. The expected lifetime in the sense any asset in farming business that will have a lifetime. Say for example, if you take a tractor that can be available with, that can be made used only for next 10 years. So that is useful life period. That is expected lifetime. If you have a sprayer, knapsack sprayer, that machine can be valid only for 5 years. After that, you need to replace it with a new machine. So that is called as life period, or you can call it as useful life period. And then finally, you have depreciation in value. Okay. So along with the listing of all the physical assets that a farmer possesses, you need to make a mention about the price of those items, value of the remaining stock, the year when it was purchased actually, the expected lifetime of the asset, and also the depreciation value of the asset. So depreciation will be dealing about that topic in the upcoming slides. So this is all about farm inventory analysis. Next, so inside the farm inventory, as I told you, the farmers will be taking care of all the assets. They'll be stocking all the assets. Okay. So in general, I told you like they'll be keeping all the assets. Each and every asset possesses some value. It has a validity, etc. It has depreciation, etc. Okay. But what are the different types of assets that you can see inside a farm business? Because each and every asset, it is having its characteristic features. It has its own characteristic features. Okay. So what are the different types of assets that a farm business can have? That we will see now. First of all, asset is a physical property or intangible right owned by a businessman or an individual that possesses a value. So farmers will own a property and that has a specific value. So assets are normally divided into three types. One is fixed assets, second one is working assets, and third one is current assets. So we will discuss about one by one. The first asset is fixed assets. So they are of the nature that it is difficult to convert them into cash very quickly, okay, to meet any current obligations, because you would have invested lots of money for such assets. The money that you invest for these assets are huge, and the number of investments that you make for these assets will be only once in a business period. That is, the amount is huge and it lasts for a long period of time. The amount that you invest for these assets is fixed over a long period of time. So say for example, land, buildings, and other long-living inventory structures. Any structure, building, machineries, costly, some 20 lakhs worth machineries that is being imported from other countries like China, Japan for conducting farming operations, okay, cultivations, etc. So such long-term assets that will be fixed for a long period of time. And those assets are the first type of assets that includes land, building, factories, furnitures, equipments, etc. The second one is the current assets. The name itself tells it is current asset, means it is the cash on hand, okay, bill recoverable. That is the amount that you are going to receive very quickly. That is the feed that you have in your hand, livestock that is available in your business, okay, that maybe very shortly will be sold. Because all these assets that is being listed here, the 6 numbers, that will give you immediate cash. But whereas here in fixed assets, these assets, one-time investments will give you money only after a long period of time, because it can be used for a long period of time. Whereas current assets, it is getting converted into cash very quickly, a very limited period of time. That is, it is highly liquidating. Okay. Example, the cash that you already have in your hand. Accounts receivable, that is the money that you will be getting from others during the farm business when you sell something. Prepaid expense, raw materials that you keep now, that will be utilized for the next production cycle very quickly. Okay, because the raw materials are getting converted into a product, and that will give you money in the form of income. So in such a way, it is highly liquidating. Very quickly, it is generating income. The next one is inventory, short-term investments, etc. So all these things are getting included as current assets. The third one is working assets. They are more liquid than fixed assets, such as farm machinery and equipment, etc. For example, if you have breeding and producing livestock, these resources will ordinarily be worn out in the normal process of business. No, in the ongoing process itself, these capitals will get exhausted. You'll be using these capitals: cash, short-term debt, inventory, operating expenses. Operating expenses in the sense, I can make it very short. When there is a business, when you call that business is in a running position, then whatever that you invest to make it run, that is called as operating expenses. Otherwise called as variable cost. Because land, building, machinery, that will be available for all the business. That is fixed cost. But when you incorporate raw materials, electricity, labor work, labor charges, wages, everything into that, then only you can call such business is in a working condition. And that is why those things are called as working assets. So these are the 3 types of assets that we have. So this is just an example, hypothetical farm inventory that is given here just for a reference. You can see here the left side corner, you have name of the inventories. That is land in acres, tubules, etc. So for different phases, these things are being used, and there may be any addition or deletion in these numbers, and the value that may either get increased or decreased. Okay, sometimes the value of the land may increase. Okay, you can see appreciation in those assets. Appreciation in the sense like normal word that we have, that we receive appreciation, no, there will be an increase in value of that particular person. If I receive an appreciation in a big gathering, in a conference or something, then that is, there is an increase in my value. The same way, if it is appreciation for an asset, not me, if there is appreciation for an asset, there is an increase in value of such asset. Okay, and that may also happen in an inventory. Sometimes there may be a decrease in the value of such assets. Why? Because you are using such asset for cultivation purpose. You are using land, you are using machineries, you are using a tractor for 1 year. So previously, before 1 year, the value of tractor may be 8 lakhs in money terms. But after usage of the same tractor for the next 1 year, its value will get decreased because of depreciation. Tamil, they call it as Taimanam. That is, there will be a reduction in its value. The asset's value will come down. That is suited for all the other assets also. If you take livestock, if you take cow, for example, if it is used for 1 year of time, you will suck milk out of the cow. Okay, you will use the cow for cultivation practices, land preparations, etc. So after 1 year of usage of such asset, there will be a depreciation in its value. Sometimes the cow can give birth to a new calf, that you can call it as an appreciation. So in the complete listing of inventory assets in a farm inventory, each and every asset will have a value. So in due course of time, this value may get appreciated or sometimes it may get depreciated. So, okay. So as I told you, you have assets, each and every asset, it has a value, possess value. So every year when you use such asset, there will be a reduction or increase in its value. Mostly there will be a reduction in its value. So we need to, at the end of every agriculture year, you need to evaluate that asset. Say for example, as I told you, say for example, 2021 July, you are purchasing a tractor. So you are using this tractor for 1 year, and next year 2020 to June, 1 year has been completed. Now you need to evaluate all the assets that is owned by your farm inventory, that is available in your farm inventory. When you take this tractor, it is being used for 1 year for all the intercultural operations, for your cultivation practices. So there will be a depreciation in your tractor. So this 8 lakhs value that you purchased the previous year, after 1 year of usage, it may come down to 7,20,000. There may be a reduction of 80,000 value in its in the value of the tractor. So why it is happening? Because you are using it. Okay. So normally how it is valuated? By using different methods, and when it is valuated, normally during any agricultural year, that is from June to July. So every June you will be evaluating your stocks, and then you will be listing out those stocks in a farm inventory. That is record, you need to make a note. So again, second year you will use it. Again, you have to depreciate. You have to reduce the value of all the assets. Then the remaining value has to be noted down in the record. Okay, so that will be happening for all the years. So how can we evaluate these assets, agricultural assets? There are many methods: cost minus depreciation, cost or market price, whichever it is lower, net selling price, replacement cost minus depreciation, etc. So as I told you, depreciation is nothing but reduction in the value of any asset. So every year when you use an asset, there will be a reduction in its value. Okay, the first method is cost minus depreciation. This method assumes that the purchase price was an approximation of the value of the asset. You can approximately take the purchase price as the value of the asset, and its value in the subsequent years can be determined by subtracting the depreciation allowance from its cost. So every year there will be a depreciation. So from the total cost, you have to subtract this depreciation amount every year. For 5 years means 5 years you have to subtract it. Okay, so the remaining money that you have after 4 years or 5 years, when you want to sell that asset, that gives the value of the asset. You can sell the asset after 3 years, after 4 years, or after 5 years. When you keep on increasing the number of years, know that these assets have been used by your farm, the value will get down. Okay, it will get decreases, right? The second method is cost or market price. Here, valuation is estimated the cost or the market price, whichever is lower. Okay, this method is commonly used for valuing purchased farm supplies. You may purchase some farm supplies. So whenever you want to sell this thing, whenever you want to evaluate this thing, at that particular point of time, what is the market price available for such assets? That will evaluate the assets. Next one is valuation at selling price. This means the price which could probably be obtained for the asset if marketed less the cost of. So if you have some asset at the 4th year or any nth year, if you want to sell this asset, if you want to evaluate this asset, You go to a marketplace where you will receive a market price for this product, right? And you need to subtract some cost from this market price, selling price. What is it? You would have spent some money to take your asset to the market. To reach the market, to reach a particular potential buyer, you would have spent some money, some 10,000 or something. And selling price may be 30,000. So 30,000 minus 10,000, that is 20,000 is the valuation at selling price. That is the value of the asset. So this is another method in which you can evaluate your assets. So next one is net selling price. That is market price less the selling cost. And the last one is valuation by replacement cost minus depreciation. So replacement cost minus depreciation, you have replacement cost, that is when you don't want to use that asset anymore, you want to replace it, you need to spend some money for replacement. Okay, minus depreciation, you have to subtract depreciation from this cost. This will be used for evaluating long-lived assets like buildings, land, etc. Okay, so these are some of the methods in which you can evaluate any agricultural assets every year. Right. So as I was telling you about depreciation, since it is coming in all these points, now you need to consider depreciation whenever you want to evaluate any agricultural assets. Okay. So first we need to know what is depreciation. As I told you, depreciate means declining. Okay. So any farm assets, there will be a declining trend of its value over the years due to usage. So why there is reduction in value? Because when you possess these assets for a number of years, you have to use these assets. So when you use these assets, there will be wear and tear. Because of that, value will get declined. So it is normal for all the assets. If you want to sell your motorbike after using it for 4 years, there will be some cracks coming out of the bikes. There will be some spoiled engines or whatever, spoiled spare parts. So based on that, you'll be reducing the value of the asset. Same way, in any farm inventory, for any farm asset that possess value, when it is used for multiple years or 1 year or 2 years sometimes, based on the time period in which it was used, there will be a reduction in its value. Okay, so that is called as depreciation. So we can classify depreciation due to physical condition and also depreciation due to financial condition. So physical condition sense, accidental damage will be there. There will be a reduction in value. There may be a wear and tear because of usage. There will be a physical decay. Some parts of the engine will get damaged in any tractor or something. There will be a deferred maintenance and neglect. You would have avoided maintaining the that particular asset. You may skip any service of the asset any time. So that may that makes the assets to lose its value over the time. And there is another depreciation called depreciation due to financial conditions. That is inadequacy. That is reduction in its efficiency. That is also depreciation. And obsolescence. That is scrap. Obsolescence is a stage where you can never use that asset anymore. You cannot use that asset anymore. So that is obsolescence stage. You will have only scrap. Okay, in Tamil they call it as what I would say. There will be some wastages available there. So that is called as obsolescence. So these are the two classification of two types of depreciation that we have. Normally, when you use any asset or when you don't use any asset, also there will be reduction in its value because of oxidation. There will be rust. There will be a formation of rust in your asset. Because of that, there will be a reduction in its value. And there are different methods of depreciation. Now we need to calculate depreciation because asset is being purchased in a particular year, after which it is used for 1 year. So after 1 year of usage, there will be a reduction in its value. So how can you calculate this value? This asset cannot tell you the actual reduction in its value. You have to calculate by seeing it, by examining it, or by using any formula. There are different types of methods that you have to estimate the depreciation amount: straight line method, annual revaluation method, diminishing balance method, sum of year digits method, compound interest method, sinking fund method, annuity charging method, insurance policy method, machine hour basis method. So out of which there are some important methods that is available here. The first one is straight line method. Straight line method in the sense you have an asset and you have a value, price of an asset when you purchased it. Okay, and you have an approximate salvage value. Salvage value in the sense after all the useful life period, say for example 10 years for tractor, 5 years for cow, 6 years for goat. So after all this full useful work period of assets, Okay, after usage, at final stage, these assets will have a small value. Okay, so that value is called as salvage value, or else that value is called as junk value, that is the waste value, or else the same value can be called as um, residual value, or you can call it as resale value, that is wastage. Residual means wastage, that is salvage value. So what you need to do, you need to subtract approximate salvage value from the purchasing price of asset, and it has to be divided with the useful life. So every asset will have a particular useful life period. So whatever the money that you has as answer, that will be the annual depreciation of that particular asset for 1 year. Annual depreciation is 1 year. So again, the remaining, after subtracting this 1,600 from 5,000, the remaining 4,400 will be taken to the second year, and that will be the value of the asset at the start of second year. So again, it will be used for 1 year. There will be a salvage value. There will be the formula. You will substitute the formula and you will find out some answer. That answer has to be subtracted from the second year value called 3,400. Now again, you will have third year usage. Again, there will be depreciation. That you will subtract this annual depreciation from the overall cost. Then you will get the remaining amount. So after 5 years of useful period, after 6 years of useful period, after 7 years of useful period, whatever value that remains in your hand, that is called as the salvage value. So for these calculations, you can take some approximate salvage value. No problem with that. Okay, but anyhow, when you apply this formula, finally you will get the actual salvage value that you can take as the correct one. So that is otherwise called as junk value or resale value or residual value. So this is the method in which an asset's value can be taken into account. And there is another method called double declining balance depreciation method. Here also you can see here the value of the actual asset is 25,000 at the start of the first year. That is the actual purchase price of the asset. Okay, it is the price at which the asset was purchased. So after 1 year of usage, there will be a 6,250 rupees depreciation, reduction in its value. So the remaining 19,000 approximately, that amount, that will be the value of the asset at the start of second year. And again, there will be a depreciation amount in the second year, 4,688. This has to be subtracted from that 19,000. So the remaining 15,000 will be kept as the value of the asset at the start of the third year. So this balance will get declined over the years. So that is why it is called as double declining balance depreciation method. So the useful life period is 9 years. So after 9 years, after reducing all this depreciation, approximately I can tell you 6 plus 4, 10, 13, 15, 16, 17, 18, 19, 20,000 or 21,000, it is coming around 22,000 it can keep. So the remaining 3,000, it is the salvage value, and that can be called as the residual value or junk value. Junk value in the sense, after using a particular asset for a more number of years, you will have some spare parts left that can be used. Say, for example, tire of a tractor, engine of a tractor, seats of a tractor, mirrors in a tractor, the handle bar that you have. So all these things may possess some value. All these things are actually scraps, wastages, what I always said, right? So these things will also have some value, and that value will be called as junk value. That will be available only after the end of all the useful life period of a particular asset. So this is called as double declining balance method. So normally you have different formulas for different methods. As I told you, purchase value of the asset minus salvage value divided by useful life of the asset. That is what we have seen here at the top. And you have diminishing balance method, cost of the asset into rate of depreciation by 100. Here in this method, what you take, you have to take an approximate rate of depreciation. Okay, normally it will be taken as 20% or 15% for any asset. Okay, if the 15% is the rate of depreciation for an asset, every year there will be a reduction of 15% of value from the total value of the asset. Say, for example, if the total value of the asset is 1 lakh rupees, at the end of 1 year of usage of an asset, there will be a reduction of 15,000 from 1 lakh. So the remaining value is 85,000 at the start of second year. And again 15,000 second year, and again remaining will be 85 means 70,000 at the start of third year. Again 15,000, then 65, 50, 45, I mean 35, etc. It keeps on moving like that. So for this particular method, how we fixed the residual value in the first method, approximate residual value or salvage value. For this method, we need to fix an approximate rate of depreciation to calculate the diminishing balancing depreciation. And you have unit of product method. Here you have to mention cost of an asset divided by salvage value divided by useful life in the form of units produced. So these are some of the different methods that you have to calculate depreciation in a farm inventory. Right. So next part of this lecture is balance sheet. It's very simple concept. These are the financial statements that is being calculated by farmers to show their net worth, not the value of the farm business, but to show the worthiness or net worth of a particular businessman or farmer. This balance sheet is being calculated. And this is being calculated every year in agriculture, that is July to June. Okay, and it has three types of components, that is asset, liabilities, and net worth. Okay, assets in the sense that is property, the value of the total property, land, building, machineries, equipments, all these things. Okay, cash on hand, etc. And liabilities is the money that the farm businessman has to give to others. That is loan amount that has to be paid to the bank, money borrowers that has to be repaid to the money lenders, friends, relatives, etc. So that is liability. So for a healthy net worth of any farmer, the asset value should be more than the value of the liability, because the liability is nothing but loan amount of that particular farmer, and asset is nothing but the total value of the asset possessed by the farmer. So the value of asset should be always more than the value of liability, that is in the name of farmer. So the remaining amount 20,000 is found to be the net worth of the farmer. Okay, that is the actual value of the farmer, and that has to be positive but not negative. It depends on how these assets and value, the value of assets and value of liabilities is getting equated. So this statement, balance sheet, is otherwise called as net worth statement because it gives the net worth of a farmer. As I told you, net worth statement is prepared for a farmer but not for his business. So it can be analyzed by number of ratios, that is net capital ratio, working ratio, and current ratio. So net capital ratio in the sense what is remaining in our hand. Net means remaining after meeting out all the expenditures. Right? You have total assets and total liabilities. If you divide it, if the value is more than 1, then you can call the net capital ratio is positive. That is, the net worth is found to be positive for the farmer. So as I already told you, total asset is nothing but the value of all the assets owned by the farmer. Owned in the sense what he possesses in his business. Okay. And the denominator denotes the total value of all the loan amount or the money that the farmer has to pay to someone. It may be paid to the relatives, it may be paid short-term, intermediate loan, long-term loan, installments, monthly installments, once in 6 months installment, once in a year installment, etc. So all the money that has to be paid to others, that will be included in liabilities. And for any business, this asset should be greater than the liabilities. Then only we can show the positive net worth of a farmer. The second ratio is working ratio. As I already told you, working ratio in the sense, these are the money that we have at the current period for running a business. So sum of working and current ratio divided by sum of medium-term liabilities and current liabilities. That is for the current time, how much money that you have. Don't include any fixed asset because fixed assets will be coming under long-term assets. That is land, building, machineries that you can keep for more number of time. You cannot sell it in the midway. Okay, you will not get money out of it very quickly. So you will skip those assets. You are taking only working assets and current assets, etc. So this money that you have in your hand, okay, the money that others have to pay you immediately, okay, the money that you can get by selling the livestock, cow, goat, sheep, etc. in your farm. So those things can be considered as working or current ratio. So that has to be divided by the medium-term liabilities and current liabilities. That is, here working ratio simply defines that in a particular period of time, if there is any problem for the farmer, which one is high for the farmer? Whether the value of the asset that he possesses at the current period or the value that he has to pay to others, that is liability at the current period. Which one is more for the farmers? Okay, if the numerator is more, then it is safe. The farmer is in safer side. If the denominator is more, that is the money that he has to pay in an immediate period of time, that is more. More means the farmer will have negative net worth in his credit. And the third one is current ratio. Here you consider only the current asset and liability. That is, current asset includes all the assets that can be converted into cash immediately. That is, if I am a farmer, if someone has to give me money, give back my money, that is current asset. The savings money that I have in my bank account, that is current asset. Okay, the jewel that I have that can be converted into cash immediately, that is current asset. Okay, the livestock, poultry, cattle, piggery unit, whatever that I have, all these assets that can be immediately converted into cash. I can sell my livestock immediately. So that can be immediately converted into cash. That is also coming under current asset. So when you add the value of all these current assets, that will give the total value of current assets, that is numerator. And immediately I have to pay some loans to someone. Short-term loan I have to pay every month. Okay, every once in 6 months, or I have to complete paying this loan within a period of 1.5 years. That is 6 to 18 months of repayment period for short-term loans, or immediate payment that I have to make to the neighbors, friends, etc. So all these loan amounts that I have to immediately pay to others, that will be included in current liabilities. So when you divide current assets and current liabilities, that value has to be more than 1 to show positive net worth or positive current ratio for a farmer. Okay, for which again the ultimate thing is the numerator current assets value should be more than the value of current liabilities, which is given in the denominator. So these are some of the analysis of net worth statement and balance sheet. And this is just a model balance sheet. As I told you, there are only 3 components. One is assets, second one is liabilities, and third one is equity. Equity is the other name given for net worth of the farmer. So net worth can be otherwise called as equity. That is the remaining cash after paying all the liabilities. You have value of asset, you have value of liability, and if you pay all the liabilities to others, what you have in rest, what is remaining in the farmer's hands, that is called as equity. And as I told you, balance sheet, assets that explains you what the owner or farmer possesses, what he owns, what he has with his hand. Liability, what he owes others, what he has to pay others. So when you subtract these assets and liabilities, that is liabilities from assets, what you get is called as owner's equity, that is farmer's equity, otherwise called as net worth of the farmers. As I told you, by using balance sheet, you are not going to calculate the net worth statement of a business, but you are going to know about the net worth of a farmer. So this is being explained by balance sheet. So to summarize this particular lecture, we have seen what is farm inventory, what are the things that is being included inside a farm inventory, how to evaluate the items that is being included in a farm inventory, that is starting from land, building, equipments, assets, other assets, tools and equipment, sickles, chemicals, saleable items that is being harvested from your farm unit, etc. will be included in farm inventory. And then to make valuation of these assets, you need to know what is depreciation, how to calculate depreciation for different assets, etc. we have discussed. And the third one is balance sheet. It has 3 components: assets, liabilities, and net worth. So if you subtract liabilities from the assets, what you get is called net worth, which is otherwise called as equity. And this net worth is not for any business unit. It is being calculated to know the net worth of the farmer. So this is all about this lecture called farm inventory and balance sheet. I hope you enjoy this lecture. We'll meet again in future course of time with some other interesting lecture. Until then, it is bye from Tulasiram. Thank you.